What if your biggest retirement risk isn't the stock market, inflation, or even Social Security, but simply living too long? Ooh, I think we want to live long, don't we? I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. And today we need to talk about something most financial advisors skip right over. It's called longevity risk, and it could be the single biggest threat to your retirement. Longevity risk. Here's a number that stopped me cold. 45% of workers say their greatest retirement fear is outliving their money, not a market crash, not losing their job, outliving their money. And honestly, that fear is well-founded. The Census Bureau tells us that women typically retire around 62, men around 65. Social Security projects that today's 63-year-olds will live on average into their mid-80s, and that's the average. That's the average. Plenty of people are living well into their 90s, some past 100. So ask yourself this. If your retirement lasts 30 or even 40 years, how well do you think your savings will hold up? Now, here's where it gets interesting. Most people plan for retirement by looking at one side of the equation, their assets, their 401k, their investment accounts, what's in the pile. But nobody talks about the liability side, the debt they're carrying into retirement, the mortgage payment, credit cards, car loans. Because here's the truth. It doesn't matter how much money you have saved if your monthly obligations are eating it up faster than you planned. I had a client, good people, retired at 65 with what they thought was plenty saved, but they still had 12 years left on their mortgage, 2 car payments, and credit card balances they'd been carrying for years. Their monthly obligations were over $4,000 before they bought a single bag of groceries. Within 5 years, they were in real trouble. Strategy beats rate always, and the strategy here starts before you retire, not after. Let's talk about a few realities every pre-retiree needs to understand. Social Security isn't a guarantee. The Social Security Trust Fund could face funding challenges as early as 2034. Now, Congress may step in before that happens. They will. But the point is, hoping Social Security covers your needs isn't a plan. Healthcare is another one people underestimate. A healthy couple retiring at 65 can expect to pay close to $315,000 out of pocket for healthcare expenses over their lifetime in retirement. That number tends to shock people. It shouldn't, but it does. And Medicare doesn't kick in until 65. So if you retire at 62 or 63, you're paying for private health insurance out of pocket for a few years, and that adds up fast. So what does this mean for you? It means retirement planning has to include your liabilities, what you owe, what you're paying each month, and what the strategy is to reduce those obligations before you stop working. That is strategic debt management, and it's exactly what we help families think through. Now, I want to share something that very few people know exists, and when I explain it, most people say the same thing. Why hasn't anyone told me about this before? It's called the Wealth Builder Loan. And you can learn more about it at gethomeselect.com, gethomeselect.com. Here's the concept. Most people think of their mortgage and their savings as two completely separate things. You make your mortgage payment every month. Your balance slowly goes down and your savings sit somewhere else doing their own thing. The Wealth Builder Loan changes that relationship entirely. Think of it like a checking account that's also your mortgage. Your income goes in, your bills go out. And every dollar sitting in that account is actively working to reduce your principal balance every single day. So what does that mean in practical terms? It means if you have $5,000 sitting in your account before your bills go out, that $5,000 is reducing the balance your interest is calculated on. Every day those dollars are in there, they're working against your mortgage balance instead of just sitting idle. And here's the part people really like. You still have full access to that money. It's not locked up. It's not tied up in equity you cannot touch. If you need it, it's there. That's the liquidity piece. Safety, liquidity, and return. This product checks all three. The result? Most families using this strategy pay off their home years earlier than they would with a traditional mortgage without making extra payments, without changing their lifestyle, just by letting their existing cash flow work smarter. Now think about what that means for retirement. Imagine walking into retirement with your home paid off, no mortgage payment, eating into your fixed income, and the equity in your home still accessible if you need it. That's not just a financial win. That changes everything about how long your money lasts. I had another client, a client in the early 50s who thought they'd be carrying their mortgage well into retirement. After we looked at the wealth builder loan and ran the numbers on their cash flow, they were on track to pay off their home nearly 8 years earlier. 8 years of mortgage payments they won't have to make in retirement. That's real money. That's real breathing room. Let's bring it all together. You evaluate every financial decision through 3 filters: safety, liquidity, and return. Most people only think about return, but safety and liquidity matter just as much, especially when you're living on a fixed income for 30 years. The goal isn't just to save more. The goal is to structure your financial house so that your money lasts as long as you do. And part of that structure is making sure your biggest monthly obligation, your mortgage, is working as hard as you are. Bottom line, if you want to learn more about the Wealth Builder loan and whether it makes sense for your situation, visit gethomeselect.com. That's gethomeselect.com. And if you want to start getting your if you want to start getting your overall financial house in order, visit rsrlinks.com/keysteps. That's rsrlinks.com/keysteps, because luck is not a plan and hope is not a strategy. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Borrow Smart segment, brought to you by gethomeselect.com, gethomeselect.com.